Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 650 videos with more than 300,000 watch hours as of December 2024. Today, we're diving deep into ESR REIT's FY2024 results, and there's a fascinating transformation story unfolding here. Let's break down what's happening and what it means for investors. ESR REIT is going through a major portfolio makeover. They've sold $534.6 million of non-core assets over FY 2023-2024 and used about $800 million to reduce debt. Think of it like renovating a house. There's some mess and inconvenience now, but the end result should be worth it. The first thing that catches my eye is the DPU figure of 2.119 cents for FY 2024. Now, this represents a trough, and there's a good reason for that. The REIT has been busy with some major moves. They've divested about 534.26 ounces of non-core assets over FY 2023-2024 and used about $800 from these sales to pay down debt. Smart move, especially with interest rates doing their roller coaster thing. What's really interesting is how their 4R strategy is playing out. Looking at the three key metrics, the portfolio land lease has jumped impressively from 37.4 years to 43.8 years by the end of 2024. That's a solid improvement that gives the REIT more stability and planning runway. Their freehold and long lease 30 years properties have increased from 54.2% to a whopping 71.6%. This is a significant shift toward higher quality, more valuable assets. The new economy assets have held steady, moving from 62.8% to 70.2%, showing they're positioning themselves well in modern, high-demand sectors. They're clearly in a transition phase with some short-term pain for long-term gain. The decommissioning of 2 fishery port properties and the limited income from recent acquisitions, 22 South Avenue 14 and ESR Yatomi Kisasaki DC, are temporary setbacks, but they're part of a bigger picture of portfolio enhancement. The REIT is showing some serious momentum with an expected 15.3 meters boost in distributable income coming from their new acquisitions, ESR Kisasaki DC and 22 South Avenue 14. This ties back nicely to what we saw in the previous slide about their portfolio enhancement strategy. They're not just acquiring properties. They're making smart moves that should drive MPI and DPU growth starting in the first half of 2025. The AEIs completed in FY 2024 are about to bear fruit. While these properties only contributed about 60-70% of their potential income last year due to ongoing works, we're looking at full-year contributions in FY 2025. This should give a nice bump to both MPI and DPU numbers. What's particularly encouraging is the pleasant 10.3% positive rental reversions from their existing portfolio. The new economy sectors are showing strong rental demand, though the rate of increase might moderate a bit in FY 2025. This shows the REIT strategy of focusing on new economy assets is paying off. On the expense side, they're playing it smart. About 90% of their portfolio is on utilities pass-through, which helps shield them from utility rate fluctuations. They're also making a big push into solar power, aiming to cover 63% of their Singapore portfolio in the next 2 years. That's some serious green initiative. They're handling the inevitable rise in repair and maintenance costs, thanks progressive wage model, by offsetting it with service charge increases of about 6.65%, and some smart contract consolidation for better economies of scale. The numbers tell an interesting story. While gross revenue came in at $370.5 million and net property income at $261.7 million, both down about 4% year over year, this aligns with what we discussed earlier about their strategic asset recycling. The DPU of 2.119 cents and NAV per unit of 27.5 cents reflect this transitional period. The portfolio metrics are particularly impressive. That 10.3% positive rental reversion is up from 11.1% in FY 2023, showing sustained pricing power. The occupancy rate stands strong at 92.3%, and their new economy exposure has reached 70.2%. exactly where they want to be in today's market. Their divestment strategy has been spot on. They've managed to sell 81 Tuas Bay Drive at a 16.7% premium and their Australian property at a 7.4% premium to valuation. On the acquisition front, they've lined up 772.6 meters worth of new properties, including ESR Yatomi Kizasaki Distribution Center and a 51% stake in 20 Tuas South Avenue 14, expected to boost DPU by 3.0%. The capital management metrics look rock solid. Their gearing at 42.8% gives them breathing room, and the cost of debt at 3.84%, down from 3.91%, is well managed. With 74.8% of interest rates hedged and a weighted average debt expiry of 2.8 years, they're well positioned for any market volatility. The mass-adjusted ICR of 2 fixed provides good coverage, and they've smartly refinanced their FY 2025 loans ahead of time. Their move into sustainability-linked and green loans shows they're thinking about the future too. This could open up new financing opportunities and potentially lower borrowing costs. The headline numbers show gross revenue at $370.5 million and NPI at $261.7 million, both down about 4% from FY 2023. This dip makes perfect sense given their strategic moves. They've sold off $440.6 million worth of non-core assets, including the Maidstone Street property in Australia and 81 Tuas Bay Drive in Singapore. Plus, they've temporarily lost some income from the 2 Fishery Port Road decommissioning. The core distributable income came in at $154.4 million, down 6.4% from last year. What's interesting is the other gains distributable income dropped significantly from $27.7 million to $9.7 million. But don't worry, this was expected since they had fewer capital gains to distribute compared to previous years. The DPU landed at 2.119 cents, showing a 17.4% decrease from last year's 2.564 cents. Now, this might look concerning at first glance, but remember what we discussed earlier. This is a transitional period. The lower DPU reflects both the temporary income gap from asset sales and the full-year impact of their equity fundraising from early 2023. The number of units increased by 3% to 7,742.5 million, which naturally affects the per-unit metrics. The beauty of this transformation is that while the numbers might look soft now, they're setting up for stronger growth ahead. Those new acquisitions we talked about earlier, ESR Yatomi Kizasaki DC and 20 Tuas South Avenue 14, are going to start contributing to income soon. Plus, the completed AEIs should start showing their full potential in the coming quarters. The gross revenue held steady at $189.6 million, practically unchanged from 2H 2023. What's encouraging is the NPI growth of 1.1% to $133.8 million. This uptick comes from their new acquisitions, ESR Yatomi Kizasaki Distribution Center and 20 Tuas South Avenue 14, plus the completed asset enhancement work at 7002, Ang Mokio Avenue 5 and 218 Senoko Loop. These gains helped offset the income loss from their strategic divestments. The core distributable income saw a 4% dip to $77.8 million, mainly due to higher borrowing costs from funding the recent acquisitions. There's also an interesting shift in the other gains distributable income. It dropped from $10.2 million to $0 this period. This makes sense given they're not distributing capital gains this time around, unlike previous periods where they used these gains to smooth out their distributions. The DPU came in at 0.997 cents, down 15.9% from 1.186 cents in 2H 2023. While this might raise some eyebrows, it's worth noting that the unit base expanded by 1.5% to 7,104.3 million units due to their preferential offering for the new acquisitions. This dilution effect, combined with the temporary income gap from their portfolio transformation, explains the lower DPU. These numbers reflect ESR REIT in the middle of their transformation journey. The slight NPI growth despite significant portfolio changes shows their core operations remain resilient. Once their new acquisitions start contributing fully and their enhanced assets ramp up, we should see these numbers improve. The total DPU for 2H 2024 comes to 0.997 cents, split into 2 payments. The first distribution of 0.722 cents covers July to early November 2024 and has already been paid out on January 8, 2025. The second portion of 0.275 cents covers mid-November through December 2024, with a record date of February 5, 2025, and payment scheduled for March 14, 2025. The split distribution timing is tied to their recent preferential offering for the 22 South Avenue 14 acquisition. They've structured it this way to ensure fair distribution between existing unit holders and those who participated in the offering. This kind of attention to detail in distribution management shows good corporate governance. Looking at the bigger picture, while the DPU might seem modest, it reflects the transitional phase we've discussed throughout our analysis. The REIT is positioning itself for stronger distributions once their new acquisitions and enhanced assets start contributing fully to income. ESR REIT is like a caterpillar in its chrysalis stage. The transformation might not look pretty now, but the butterfly emerging should be worth the wait. The management team has shown they can execute on their strategy, selling assets above valuation and reinvesting in higher quality properties. For investors, this could be an opportunity to get in during the transformation phase. The current price reflects the temporary DPU dip, but not necessarily the improved portfolio quality and future growth potential. That's my take on ESR REIT's FY 2024 results. Remember to like, subscribe, and hit that notification bell to stay updated on more REIT analyses. This is Iggy from the Investing Iguana, signing off.